All right, let's go ahead and get started, gang. This review is kind of going to be in two parts, which your exam is going to be multiple choice, and of course, you're going to have a problem in the back. That's going to be journalizing, and we're going to do the journalizing part after we go through the statements. Hopefully, everyone is kind of familiar with the framework. And when we're talking about framework, we're talking about the debits and the credits, how we increase and decrease accounts, because that's very, very critical. And I'll say this. So let me just ask you this. When we're looking at these accounts up here, here's accounts with account balances, right? These are beginning balances. And these are as of July 31st that we see here. But we're gonna prepare income statement, retained earnings, and a balance sheet. But before we do that, just want to talk about it a little bit. See if I can move this up just a tad. There you go. So we can see as of. So we have to understand the accounts and how to categorize these accounts. So if I'm looking at them, and I ask this question, if I'm looking at salaries and wages payable, what type of account is that? It's a liability, absolutely. That's some things that we have to know when we're doing it. It is a liability. So how would I increase a liability? With a debit or credit? Credit, absolutely, with a credit. So we got expenses. So expenses is gonna, how you increase and decrease expenses with what? How you increase it? Credit. Debit. Expenses are increased with a debit. Expenses are increased with a debit. Revenues, as you see, you got revenue. You would increase revenues with a credit. You typically don't decrease revenues at this time. You probably won't. At this time, you won't be decreasing expenses either. But you won't see that other side. We talked about liabilities and the payables. How about common stock? Debit or credit? Credit, absolutely, credit. And you got cash. What type of account cash is? Is an asset, and we already established. Assets are increased with what? Debit or credit? Debit, absolutely. Accounts receivable is also what? An asset, right? Dividends you'll note there's some dividends. They say dividends are not an expense. The only way you're gonna see dividends is you're gonna see them in the retained earnings. That's the only way you're gonna see dividends. Then we got rent expense, and then we got retained earnings at the beginning of the year. Now, where is retained earnings located? Where would it be located? Like what kind of account retained earnings? Stockholders' equity. That's right. It would be stockholders' equity. Absolutely. Now, what I want you to do, and I want you to attempt this, I'm gonna give you a few minutes to attempt this. I always like to attempt stuff first. Let's go and prepare a income statement for me. See if you can prepare an income statement. Now, you gotta pull the accounts out of here to prepare that income statement. And tell me whether you got a net income or a loss. Now, let me ask you this. What type of accounts go into an income statement? Revenues and expenses only. So that's all you need to be picking out for an income statement. Revenue and expenses. Absolutely. And we'll give you a moment just to see if you can work that up right quick. And then we're going to talk about it. Well, you got to set them up in terms of the income statement. You have your revenues first, and then you got your expenses. And then the difference is going to be a net income or loss, depending on it. I'm going to show you that once we do it. But I want you to attempt it. How many of y'all have prepared statements before? Y'all have? Okay. We're gonna go back over it. That's what we're gonna do. We're gonna go back over it. But I want you to try that for a minute. I want you to try that. One that I like you to give it a try before I just give you the answer. Remember what we're looking at in the income statement is revenue and expenses. And this kind of puts you in the testing environment. So you gotta go in and pick these accounts out. I'm gonna give you a few minutes and then I'm gonna show you the solution. And we are doing these in order of how you have to prepare it. When I say in order, you have to do the income statement first, then you have to do the statement of retained earnings, and then you have to do the balance sheet last. So that's the order. Remember that you could get a question on the order of preparing the statements. Yes.
Do we need to like do something of order of liquidity or non-order?
Not yet. When we get ready to do the balance sheet, yes. Yes. Take an attempt, even if you're not sure. Just try it. Yeah, I see that sound. There's people coming in and out of Zoom. So if we're looking at this, right? What accounts are we gonna pick out of here to go in that income statement?
Salary and wages expense.
Salary, wages, expense. Say that again.
Utilities.
Utilities expense, definitely.
Service revenue.
Service revenue, yes.
Revenue
Rent revenue, yes.
and rent expense.
That sounds about right. So let's see what it looks like. We'll move it up. Let's see what it looks like. We're gonna do those journal entries later. That's what it should look like. Right? We got revenues. Of course, we label it. That's the corporation we're working with. Income statement, right? And and you got for the year ended. Now notice, and you're gonna notice the difference between that date and the balance sheet date. It's gonna be the way they presented the balance sheet. The balance sheet date is gonna be different. Because income statement is for some period of time, from this period to this period. So we saying for the year ended July 31st, 2023. So we got the service revenue, we got the rent revenue added together, and the spelling is not quite right there, but don't worry about it. We got total revenues when you add them of 80,600. Then we got expenses, you got salaries and wages, you got utilities, you got rent expense, We add those together, the expenses together, we got 77,300. Then we're gonna subtract the expenses from the revenue, and that's gonna give us our net income. Yes,
Why doesn't that include like the salaries and wages payable for like the like accounts payable and stuff?
yes. He said, why doesn't it include, I like to let everybody know that. Why didn't it include the payables? And she said, because they're liabilities. Absolutely, payables are liabilities. Now, we are gonna use those, but what statement are we gonna use those in? Say it again? The balance sheet. That's where we're gonna pick those up. We're gonna pick those up in the balance sheet, and we're gonna get to that after this. Now, we have a net income of 3,300, right? Now, that could be a loss. If that was a loss, what I'm saying, you can also have a loss and not a net income. If that was a loss, what would have had to happen in this scenario?
Expenses exceed revenues.
Yes, absolutely. Expenses would exceed revenue, because that can happen. Generally, companies, when they first start out, they don't always start out making money. They start out making a loss a lot of times. So generally, they end up with more expenses than they have revenue. If you have more expenses than revenue, then that would be a loss. So you have a parenthesis around it as a net loss instead of a net income. Now, what I want you to do with the next statement is I want you to do a statement of retained earnings, because remember, we got to do them in order. We have to do the income statement first, then we have to do the statement of retained earnings. I'm gonna take you back up to the data so you can see it. So everybody did get that income, right? Okay. Now from there, I want you to do the attempt to do a statement of retained earnings for. Give you a few minutes to work on that. Yeah.
We just don't do it.
That's good. I want you to do it. No, that's good. I knew some probably wouldn't. So that's why I'm doing this for you. So when we're doing the statement of retained earnings, what goes into that statement?
We can count, well, we retain earnings at the beginning of the year, net income is the beginnings.
Yes, you said the retained earnings for the beginning of the year, which they gave us, right? Right here. And then she said income and dividends goes into that statement. That's where you're gonna see dividends at. That's the only place you're gonna see dividends at. You're gonna see it in that retained earnings. Not gonna see it any other place. Now, remember, dividends is not an expense. They could ask you that question. Dividends is not an expense. Income, net income, or net loss, if it's a net loss. I'm gonna put the solution up for you right quick. I know some of you have already did it already. So that's that net income. We got to take that net income with us. And this is why we have to do these statements in order. See that? Is that what y'all got? The beginning, retained earnings, we pull the net income down, we add it. Now, if that was a net loss, we would subtract it. If it was a net loss, we would subtract it. We subtract out the dividends, and that's the difference with that 1,300 And the ending retained earnings is 43,500. So that's our ending retained earnings. Remember, if this was a net loss, it would be in parentheses, and you would have subtracted it from the beginning retained earnings.
How come, in the first like retained earnings, you say August 1st, 2020, this is just like, essentially the year ended, you just go a year before.
A year, yes.
Or like the date it says there.
Absolutely. And generally a year is 12 months.
Yeah.
Yeah. And sometimes it may not be a year. Sometimes you could be doing it for a month.
Yeah.
Yeah. So just make sure you look at the dates and see what, if they want a month or do they want a year, just make sure you're clear on what they're looking for when you read the question. So now that's our retained earnings. So remember, it has to go in order. Income statement first, then the retained earnings second. Now we can do the next statement, and that's our balance sheet. So I'm gonna take you back up to the data. I know some of you have done it already. Take you back up to the data. Do you have any questions out there? Yeah.
Sorry, I know you said
No, no.
starting, but if it was a net loss, then it would be like 5,300.
Yes, absolutely. That's net loss. Yeah. You would add, because that dividends and this would be added together. Yeah, that would be yeah, absolutely. Yes.
All right, so since get the return income.
Yes,
The return earnings statement
Mhm.
is net income minus the dividends.
Yeah, net income minus the dividend, yeah, right here. When you subtract those two, you're gonna get that 1,300 right there, yeah. That's what's off to the side, yeah. And then you take this and you add it together, and that's how you get your ending retained earnings. Now, that's critical now, because the ending retained earnings, you have to take that somewhere. Where you take it? You're gonna take it to the balance sheet. That's why it's critical that you understand between the beginning retained earnings and the ending, because you could get a question, right? Could get a question where they have both of those in, and they want you to do a balance. The ending retained earnings is going to balance sheet, not the beginning, ending. So I want you to try the balance sheet right quick. I know some of you have already done it, but let's go back up to the data. If I'm moving too fast, y'all slow me down. Let's go back up to the data. Now I want you to do me a balance sheet. Now, what goes into the balance sheet? What type of account?
Assets, liabilities.
Absolutely right. Assets, liabilities, and stockholders' equity. And what's the unique thing about the balance sheet? What does it have to do? It has to balance. And what comes into effect when it balances that the accounting equation, right? Y'all remember that accounting equation? Because they're gonna ask you about it. A equal liabilities plus stockholders' equity, right? That's what that balance sheet is doing. That's exactly what it's doing. And that's how you balancing it out. So I'm gonna give you a moment to see if you could, yes, put that together for me. A equals. Absolutely. That means your assets.
Dr. Montgomery.
I can't hear them. Give you a moment to work that up for a second. Let me check on something. Just work on that, I'll be right back. Yes. He asked, what's the difference between a balance sheet and a trial balance? Y'all did a trial balance before. Now, what's the purpose of a trial balance? That's a good question, because they are different. Anybody know the purpose of a trial balance?
To make sure that credits and debits balance.
Yeah. Make sure, that's right, make sure your debits and your credits balance after you've done your transactions. Generally, once you go through, you do your transactions, you post them to the general ledger, right? Those are the T accounts. Then you get balances in those T accounts. Then you transfer it to a trial balance. That helps you to see if you're still in balance, because if you're not in balance at the trial balance, then you can't move on to prepare these statements that we're doing now. So the trial balance is done before we do these statements. Technically, we just kind of shortcut it today, but the trial balance has to be done before you do the statements, or it's, because if you get to the trial balance and it don't balance, there's no need of doing the statements, because the statements would not balance. Yeah, that's a good question. I know I got some people asking some questions on the Zoom. I can't hear you, but the moderator is going to come in with some questions, and I'll answer you from that standpoint. Yeah, we actually preparing. Yeah, we prepared the other stuff, and I'll go back and show you that. But we on the balance sheet now. We're gonna be doing that next. So we're doing the balance sheet now. We just went over the income statement and the statement of retained. Yeah. I'm giving them some time to work the balance sheet there.
Yeah, could I, so, I'm here Monday through Friday class, and I missed the past couple of days.
Yeah, and,
Because I had jury duty, am I still able to turn that in?
Yeah.
And I,
it's right in the chat.
oh, good, okay, perfect, thanks.
Yeah.
I'll get the answer, but they get that back to me, but that's what we went over. You can check it.
hey,
Yeah,
I've done a bunch of videos and stuff. I had to do a bunch.
I understand.
Where it's like six, so it just goes funny.
That's all right.
So like I know there's like cash,
That's the assets.
assets, it's like cash.
So you need your assets side. So you're gonna need cash, right? Accounts receivable. What's the other?
It's not the payable, right?
But now the payables is gonna be under the library. So that's, you got assets? No. You don't need a revenue.
So I just the payable. And then.
Assets
Asset.
and the equities.
That's what you can say.
Well, have retained earnings, and you got common stock. in it too.
Okay. So those are.
Those are equities. But remember though, you need the ending retained earnings, not the beginning.
Oh, so I. Yeah.
You don't need this one. You need the one you just computed in the retained earnings statement. Yeah,
That's fine.
because if you do that, it won't balance. It won't balance if you don't get the ending. Yes.
All right, so it doesn't matter, right.
Yeah, what we're doing is this is a good question. We're doing a classified balance sheet. When you're doing a classified balance sheet, you have to split those assets and liabilities up into current and non-current. Your current assets are gonna be in liquidity order. You might get that question. You list those current assets in liquidity order. And generally cash is first, then accounts receivable, then you got supplies. Then you're gonna get some additional accounts, like inventories. You got prepaids are gonna be up in there. Those are gonna be current assets too. So you have to split your current assets up and then get a total current assets, and then everything else go beneath that as assets. So you'll see when I put it up there how we did it. That's called a classified. If it wasn't a classified, you would just kind of lump all the assets together. And then lump all the liabilities together. It was not a classified. Classified is they want to know the short term and the long term of things. Like in particularly in your liability section, they're gonna want to know what's short term and what's long term. You got to split those up. You have to classify it. We'll see it when I break it out. And that's one of the reasons why you see this accounts payable. It says it's due. See, when it's due, they're telling you that that's a long term. Why? What is a short term liability as far as a payable? What? Less than a year, yeah. Accounts payable is short term. It is. But anything that's less than a year is considered short term. That's short term. Anything greater than a year is considered long term. And you have to split those up in a classified balance. You have to split them up.
So we're doing the classified balance sheet.
We're doing a classified, yeah. So you're gonna have to split your current and your non-current assets up, as well as your liability. I'll show you it in a minute, how it's split up. But that's a good question, good question. Yeah, payables and liability, yeah. Anything with a payable, and as you go further into the chapters, these accounts are gonna increase. You're gonna get more payables, different kind of payables, you're gonna get, bonds payable gonna come in. You got that payable on it, it's gonna be a liability. Now, you will have a liability that won't have payable in there. And you probably have seen it, heard of it, and it's called deferred revenue. That's a liability, but it doesn't have payable in it. But it's a liability. That's one of the few that you want to have that payable in. You're gonna have that deferred revenue. They also know it's unearned revenue. We'll talk about that too. That's the only thing that won't. Everything else, you'll probably have payable in it that help you separate the liability. Still using those payable. It's just it's below. It's long term. Yeah, that's all of it. Yep. So when you see these dates, that's what they're trying to do. Distinguish between the long term and the short term payable. But just remember, because you could get a question on that, what constitutes short term liability versus the long term.
It isn't occurring.
No, equipment is not. No, that's right. And I'm gonna go ahead. I'm gonna put it up because I know some people. And I'm gonna scroll up some more, but it's just to get us started. I want to point out that when you do the that should be balance sheet, right? This should be balance sheet. I'm seeing here, this should be balance sheet, not retained earnings. That should be balance sheet. And you notice on the balance sheet, it has at July 31st. At July 31st, not for the year ending. That's a difference in terms of the date. I missed that. Remember, this should be balance sheet, not statement of retained earnings. We did that already. So here we got listed current assets, cash, accounts receivable. It's the only current assets that we got. We total those up. We got current assets of $42,980. And the only long-term we got down here, or property, plant, and equipment, you'll notice when we get there later on, they're gonna call it a fixed asset as you go further on. We got equipment, so we add them both together, it's gonna give us total assets. Total assets is coming up to $57,980. Now, of course, this is just giving you an example, but you could have other assets in it. You could have land, you could have vehicles, other physical type Tangible, and buildings could be another one, could be in there. Yeah, absolutely, buildings could be in there. So now we got the total assets. Now we're gonna come down here to the liabilities. I'm gonna move it up so you can see it. You got your current liabilities, which is the accounts payable, the salaries and wages payable. Add those together, give us a total current liabilities of $6,680. And here we got that long-term note payable down here of the 1,800. So we're gonna add those up to give us total liabilities. Now, of course, you could have more current liabilities. You could have more non-current liabilities. Then we go down to the stockholders' equity, right? We got common stock at 6,000. And then we got the ending retained earnings. Ending retained earnings. And that's when you see the 43,500, the ending retained earnings. We add those together to give us the total stockholders' equity. That's gonna give us the total stockholders' equity when you add those two together. Now, to see if we balance, we're gonna test that equation now, right? That equation says my assets should equal my liabilities plus my stockholders' equity.
So that's how the flat, that's not the trial balance, like that's the last.
No, this is not the trial balance. No, these steps are after the trial balance.
So this is like the final.
This is the final. Yeah, these are the final. Yep. If our trial balance and we know what we're doing in the trial balance, we checking the debits and the credits after we reported the transaction, right? We'll talk a little bit more about it because we're gonna do some transactions. Once that trial balance agrees, then we move to these statements.
Right.
And we can't move to these statements unless that trial balance agrees. So now, as you can see, my stockholders' equity and liabilities is 59,980. And we're gonna compare that to our total assets, right? Up here, see the total assets there? Total assets is 57,980. This is how we know we balance. It's gonna, typically this is gonna balance. If you did the trial balance and that trial balance, when you get to the balance sheet, it should balance. It should balance. If you've done the trial balance and the balance, this should balance. If it doesn't, that means you may have got some things in the wrong place or something like that, but it's typically it should balance. Trying to think of what else I want to mention in here. I think that's yes. Uh-huh.
So you said that like the total stockholders equity, or even the total stockholders equity and liabilities.
Stockholders equity and liability.
That equal to assets.
They're equal to assets.
Oh.
Yeah, let's go back up and look at that. Right? See it right there? Because you gotta take your total liabilities plus the stockholders equity right there. That 49,500, that's the results of this. Then you add these two together right here. That's gonna give you the stockholders equity and liability. That's what should agree to the asset. This way.
Total liabilities and total stockholders equity.
Mm-hmm. Yeah, that should agree. Y'all all right? Now, on your exam, you're gonna have some transactions, right? And you're gonna have to record them in the general journal. These transactions, the debit and credits is in the general journal, that's where we record it. And then, once you record transactions in the general journal, which we're gonna do next, it's quite a few of them. After we record them, what do we do next? Post them to the ledger. And the ledger she's talking about is those T accounts. That's considered the general ledger. Those accounts sit in the general ledger. You record the transactions in the general journal and you post to the ledger, right? And I'm taking you through the cycle here again, the accounting cycle. Once you post to the general ledger, you gotta get summaries in those accounts, right? Those T accounts. That's when you go out and get your summaries and you get your account balance. In the T accounts, how you typically get your account balances in a T account? You subtract your debits and your credits, absolutely. Subtract your debits and credits, and it's gonna give you a balance in the T account. From that balance is where you go and generate that trial balance. That's where you generate that trial balance, and you gotta compare it, my debits and credits still match. Once you do that, that's when you do those statements we just did. Those are the final product. Those statements are the final product. I want to make sure we was clear on that cycle, because you could get a question, a multiple choice question, in asking you a question like that. So what I want you to do now is we're going to go through some transactions, right? And I want you to record these transactions. There we go. In the general journal format, that's the debits and the credits in the general journal format. I want you to see if you can go through, we'll give you a little bit of time, and we're gonna talk about it. I want you to see if you can record these. And this is where you gotta use that framework to make sure you know how to increase and decrease accounts in terms of the transactions. So I'm gonna give you a little bit of time to do that. And then we're gonna talk about each of these transactions. You'll have this on your exam for sure in the last problem. You'll have, probably won't be as many, but you'll have to do that in the general journal format on the last problem.
So we'll have to fill it in.
Yeah, you'll have to fill it in. It'll be some space for you to do it, but you'll have to fill it in. Now, the statements we did, you won't do a full set of statements. There are actually questions about it. They'll put some numbers up there and they say, what, they'll ask you what are total assets or, what are total liabilities, and you have to kind of pick it out, that kind of thing. But you won't do a full set of statements on the exam. So, but this you will record these into the general journal. Usually it's the last problem. So I'm gonna give you a little bit of time to see if you can record those for me, and then we'll talk about them. You gave that other thing back? Yeah, you did look at that. Perfect. Yeah. Yes. And they giving you money. Yeah, so that would be credit. Yeah. So then. And remember, when you're doing your journal entries, the debits are first and the credits are second. The debits are first and the credits are second. Yes. And then you're gonna put the line, you got debit and credit like that. Yep. So of course your account title is gonna be.
Oh, so account.
Now, remember, you gotta kind of get used to the account titles. They're not gonna give you the account titles on the exam, you're gonna have to write them in.
So they won't.
Well, you'll have those related to another problem, but when you do the journal entries, it won't come like this. It's just gonna be like this.
So we have to remember.
Yeah, yeah, Now, I can tell you a testing, technique. What you can do when you're taking a test and you get back to those journals, if you're unsure of the account title, you can always start looking back through your exam and see if it says something stands out in your exam. Because there will be some charts in there with those accounts in it.
I see what you did with this.
Yeah.
Is that whatever the account title were, you put them on a T account.
Yeah.
So the test won't be like that.
No, it won't, but you'll still have that data, like some questions will have that data.
Okay.
So you can always go
Some
back,
of them are related to the.
some of them are related, yeah, you can still go back up and pick it out. Okay. That's right, that's it.
Do I have to- Oh, I have to go see the first thing that we
Mhm.
okay.
Remember, when you're doing your debits and credits, what has to happen when you report a transaction? What we know happen?
Yeah, the credits have to be considered.
The debits and the credits has to equal. That's right. The debits and the credits, yeah, they have to equal. Yes. Mm-hmm.
So if I have this right for you to do
Okay. Okay, okay.
but then if it's that, then I just do this.
You paid it now, you paid it. You
But
paid.
then, so it would be,
Uh-huh.
oh,
Absolutely.
wait, no.
No, yeah, because you're paying on this.
Oh,
You're
okay,
paying that
so
down.
If I see a credit of that, at some point it has to be on the left.
It has to, because you got to reduce it. You gotta reduce it.
And
Yeah.
then it's just one line, and then it goes to the next number 5.
No, well, you got, in every transaction, you have to have at least 2 accounts.
But if it's. Then what would I do?
Every transaction has to have 2 accounts. So if you got that one, you gotta have another. That's in that
For
transaction.
number 4,
Uh-huh. You gotta have another, you have that.
and it's not.
What are you doing in that case? What are you doing? What does it?
Oh.
There you go. There you go. Yep. Yep. That's right. Yep. Now, one of those transactions is gonna be, it's gonna have more than 2 accounts. One of them's gonna have 3. One of them's gonna have 3. Yes.
It's, but it's hard for me to explain it, but can you explain to me why it's the debt that he wants it credit, with the, like, it's, what, that he's paying his taxes. That's something.
It depends on what you're doing with the cash. So if you're receiving, that means your cash is increasing. Yeah, yes. If you're paying it, your cash is gonna be a credit because it's leaving. Yeah, yeah, exactly. Oh, okay. Yeah, yeah. This is good because you gotta know these transactions. This is worth a lot of points on the exam.
This one.
Yes. We did them first.
So. Says we're paying 250. So. The receivable for the debits.
It's because you're paying, right, so,
So you gotta go back up there to two, see what you did with two.
yeah, so,
So you paying on this.
yeah. So I've been paid.
Exactly. That's right.
Okay.
Oh, that's right. You gotta leave, man. 5 o'clock. Mhm. Yeah. Yeah. Mhm. Yeah, you might not have up to the top, you might have not have all the accounts. You might have to, create an account depending on the transaction. So all the accounts may not always be up to the top. If you got down here and you needed another account, you may have to create it down in the transaction section.
I have to subtract the 2,500 is like,
Yeah, yeah, find the difference.
now, would that be like, third, like all three, right?
Yeah, you would have 3 accounts in number 3 instead of 2.
The same amount of money.
Yes, your debits and your. Yeah,
So they're not just gonna say,
well. You got equipment. How much you bought the equipment?
about
Okay, so we know you do equipment for example. Yes.
okay, now it is,
You're gonna have 3 accounts. You're gonna have equipment, then you pay some money. See, when you pay some money, and then you got a difference.
the next part, like, the note.
And no,
That would be the payable.
there you go.
Is that okay? I think.
Which one?
Well, five,
It's like the opposite.
Yeah.
Yeah, I would be, yeah, but anytime you pay something, that means
Yeah,
money.
exactly.
so that would be cash.
Gotta be cash.
If it's a state.
If it says pay, that's what you got. That's gonna be revenue. Yeah, yeah, anytime you perform a service. It's gonna be revenue.
And borrowing is borrowing the cash. Out of your,
Borrow. Where you at, where you see that, yeah, you borrow it from the bank, yeah, absolutely, you borrow cash. And if you borrow from the bank, what you gonna have in that? Cash, right? What else you gonna have when you borrow from the bank?
loan.
You gonna have a loan.
Oh, so.
And but
so
you're gonna have
we
to sign a note,
It would go cash and then it would go notes.
yeah? Yeah. And remember too, and this is something that could be on exam, right? We're on the accrual basis of accounting, right? We know that's what accounting is, accrual basis. We know accounting is not cash basis, right? Just remember that, it's not cash basis, because cash basis is not GAAP. What GAAP stand for? Generally accepted accounting principles. Remember that too. Remember that too, generally accepted accounting principles, GAAP, generally accepted accounting principles. It could actually that too. Not, they will actually. They will actually.
Generally accepted.
Accounting principles.
What was it?
I told you that accounting is on the accrual basis and accrual basis and not cash basis. Cash basis is not GAAP, is not GAAP. Cash basis is not GAAP. Now, just remember revenues are recorded, and this is the revenue recognition principle. Revenues are recorded when what? When you record revenue, what has to happen to record? It has to be done. Or goods are received. Goods are received, have to be received, and service have to be done in order to record revenue. If someone gives you money to do something and you haven't done it, what account are you gonna use? Deferred, there you go, perfect, deferred, that's revenue recognition.
Great.
Yes, absolutely, that's right.
So when the question be like, oh, I dropped off piano today, but they won't work on it until April, that will be.
Got to be too early, yeah, it will, that's right. Let's look at what y'all got, right? Let's kind of go through this a little bit. And I'm gonna show you the answer. So the first one says issue common stock for $100,000 cash, right? You received cash, didn't you, right? You received cash. And you gave them a stock certificate. I'm gonna keep going back and forth with this. Let's go down here. And show you the answers to this. We're gonna talk about it. So in that case, how many of y'all get this so far? Y'all all right with this? Good. You got cash coming in. Of course, common stock goes up, cash goes up. Number two said, we did what in number two? What did we do in number two? Purchase supplies on credit. Now, what was the key to let you know that you purchased it on credit? Did they say purchase on credit?
Yeah.
Oh, they did. Okay, there you go. They could use the term purchase on account too. Remember, they could say purchase on account. That's the same thing as purchase on credit. And typically, when they say purchase on account, purchase on credit, they're talking about accounts payable. They're talking about accounts payable. Only time you're gonna use notes payable is when you sign a note. You sign a note for something, you're gonna use note. That's the difference between accounts payable and notes payable. You're gonna sign a note. Another thing is a notes payable could be created if you borrowed, we're gonna see that if you borrowed money from the bank. It may not say you signed it, but it's gonna say you borrowed money from the bank. The assumption is you can't leave the bank borrowing money without signing a note. So it may not say, hey, it's, you signed a note from the bank, but it may say you borrowed money from the bank. It's still a note, if you remember, it's still a note. Number three, that's a compound entry there. Remember, I told you in every transaction, you have to have a debit and a credit, and they must equal. The debits and the credit must equal with every transaction. Number three says you bought some equipment. It cost $25,000. You paid some cash down, right? And the difference, it said what? You signed a note. That's where you see the notes payable. Notice 25 on the debit side. You add those up, it has to equal 25 because your debits and your credits have to equal. Yeah.
Marketing is. How do you know which one is to put like safe one where it says accounts payable cash? Like what if you have put cash and then accounts payable?
Well, typically you want to put whatever you debit and you want to put debits first. You always want to put your debits first and then your credits comes second in terms of that. The reason why you did it that way in number four is what's going on in number four? You paid cash, right? On an account that happened in what? Transaction 2. So you created an accounts payable in transaction 2. And then when you get to 4, you're paying some money on it because you had a $500 accounts payable out. And then when you get to number 4, they saying you're paying some money on it. So in order to pay the money on it, you got to reduce that accounts payable. You have to reduce.
I see what you're saying.
Yeah. Yep, you credit it and you gotta reduce it. The key thing is you gotta reduce that accounts payable. You gotta reduce that accounts payable when you're paying down. Why? Because you still have a balance in that accounts payable. At this point, what's your balance in accounts payable? It's $250. You have to keep track of that. And generally, when you get into how many county managers I got it? You got, generally, when you get into the county office, yeah, you always gonna be the lone one, I say, it's always like that in class, it's always like that. Generally, and I tell my students, generally, when you get into the accounting world, especially working for a company, you're gonna have general accounting. Those are the ones that's gonna be debiting the credit, they're gonna be doing the general type accounting. Then you're gonna have accounts payable down the hall, you may have accounts receivable down the hall. And based upon what the balance is in accounts payable, they're gonna pay it. So if you don't reduce this accounts payable, they're gonna go ahead and keep paying $500 when it's not due $500. So you gotta reduce that accounts payable, so your accounts payable department don't go out and paying money that they shouldn't be paid. So companies do that. They double pay sometimes when they don't do that. So that's what's happening here. You're reducing that accounts payable in that transaction. Then you got number 5. What number 5 says?
For the month of
August, September, and October. So in that case, we prepaid our rent. We prepaid it ahead of time. Accounting says, GAAP says that it's not an expense. It's only an expense when it has occurred. Y'all remember that? When it's occurred, that's the another principle there. It has to have happened. And in this case, you haven't used any of the rent. That's why it's prepaid. Prepaid is what kind of an asset? I'm telling you right there. Prepaid is an asset account, not an expense. It's an asset account. Until you use it, it becomes an expense. Yeah, you'll see that in chapter 4, where you have to fix those accounts when they're like.
For the account name, I have put prepaid expense, so it's been wrong.
Yeah, because you can't have a prepaid and an expense at the same time.
I didn't know the right name.
You go with it. Yeah, it's a prepaid, and whatever you do, whatever you prepaid, you can just name it, because you prepaid rent, so it's gonna be prepaid rent. You can have a prepaid insurance. You can pay your insurance up ahead of time before you have to use it. That's an asset, that's a prepaid insurance. So whatever you prepay, that's what you use. You prepay whatever it is that you do. So that, and you'll see in chapter 4, we're gonna go back and adjust that account. In chapter 4, we'll adjust it, fix it, and if we use the expense, then we're gonna convert it out of prepaid rent to rent expense. We're gonna move it. But we'll see that in chapter 4, where you'll do that. But yes.
And on the test, we're gonna definitely have to like memorize like prepaid rent.
Yeah.
Okay, so
Yeah, but what I told you the trick to that is, right? She said, we gotta remember these accounts. Yeah, you gotta remember these accounts. But what I told you a trick to that is when you're taking a test. Go back and start looking through your test. You may see it already somewhere that can jog what that is. Say, oh man, I don't know what that account is. I know. Start flipping back to your test and see if something in there kind of jog your memory of what it is. Because you have to let us know that you know exactly what it is. Now, if you look at prepaid, like you said, prepaid expense, there's nothing I can do because I got an asset and I got an expense. So it's nothing I can do. Yeah. So how y'all doing? Y'all doing all right? All right, 6 says you pay some wages, right? Salary, wages, expense. $2,500. That's where we at. Yeah. Where we at? That's 6. Yeah. That's 6, yeah. Y'all agree with that? All right, 7, perform, that's the key. That's the key right there, right? You perform services. You perform services and you receive cash from a customer. So you receive the cash, right? There's your cash and debit. There's service revenue. We can record it as service revenue because we have performed it. We have performed it already. What about 8? Did they give you any problems?
I originally thought it was a deferred revenue, but then, you know, that's when you pay in advance. So.
Yeah, that's when you pay, exactly. Because like I said, you performed it already, so it's revenue once you performed it.
So,
And it was built on account, so they didn't give you any cash for it, so it's on account. When they don't pay it, that's where the accounts receivable come in.
so the service revenue is always gonna be credit.
Yes, yeah, that's another thing too, remember, that revenue is gonna be, it's gonna be credited. It's gonna be credited. At this stage, you're not gonna debit a revenue. You're not gonna debit a revenue at this stage. Yes,
Why is it?
my accounting person, maybe later on, down the road, you get an intermediate accounting or something, you may see something.
Why is it receivable?
She said, why is it receivable? Right? It's receivable because they still owe you the money. Because you've done the service and you haven't gotten the money. So now you put in a receivable and you're gonna chase them for it later. You're gonna chase that money down for them to pay you later. Until they pay you. Now, once they pay you, did we have somewhere you paid already, Donnie? No.
If it's-
Yeah, right here, number 9. Yeah, number 9. See number 9 said? Collected.
The other, it's the other way, like they owe you, it's accounts payable.
Yeah. So number 9 says we're gonna collect some of that, right? Well, actually, we're collecting all of it. So you'll see the cash coming in that they owed you. And then remember, you gotta go back and reduce that account receivable. Gotta go down because you don't want that receivable staying out there. And I told my class sometime, you know, you have a receivable, and a receivable, you're gonna start getting bills. Saying, hey, this person owes this person owes that. So if you don't reduce that receivable, somebody could be getting a bill that they should not be getting. So you gotta reduce that receivable once they pay it. Number 10 says you borrow 15,000 cash from a local bank. Remember I told you, it may not say sign a note, but if you got it from a bank, it's a note. It's a note if you got it from a bank. And then they told you what, 3 years? So if they told you 3 years, what type of notes payable is it? Long term, absolutely. It's a long term notes payable. The last one? No, this one we can, yeah.
Do you label like you do put long term expenses, you got the notes payable or?
Yeah, you can, but it's not gonna be,
You won't
No.
do that from the actual general?
no. Yeah. But you'll know it, when you prepare the balance sheet, you would have to put it in the right spot, so you have to know what it is, yeah. Number 11 says on the last day of the month, receive 1,300 in advance for services to be performed, right? During the following month. So that's the first. Absolutely is the first. We're gonna take care of that in the following month, but they gave us the money now. So we're gonna have to put that in the, which is a liability account, right? And why do you think they put it in deferred account? Why do you think they put it in a liability account? Because if you don't do it, guess what? You gotta get the money back. You gotta get the money back if you don't do it. And I always give this example when it comes to deferred. Y'all go to the games, football games and stuff? Yeah, you buy your season tickets, right? You buy your season tickets. FSU, FAMU, when you buy those season tickets, FAMU or FSU will debit the cash, they're gonna credit deferred ticket revenue. They're gonna credit deferred ticket revenue until that game is played. Because if they don't play the game, that's what they gotta do. They gotta get the money back. So they'll put in the deferred ticket revenue until that game is played, then they'll move the ticket revenue. Once it's played, yes.
But why? So why is 11, if you receive the money, why is that cash instead of Can't receive it.
Oh, you got it, because you got the money.
Oh,
It said you received it, so you got the money in your hand.
right.
So if you got the money in your hand, you gotta put it in your cash account. Yeah, if you got it in there, you gotta put it in your cash account. Yep. That's why, because you got the money. Yeah, you got it. Yeah.
So when somebody has something on accounts payable
Mm-hmm.
and they're paying it off,
Right,
and then they pay you, so then it's account receivable?
they paid it off, right?
Yeah, like,
How much supplies?
no, the situation with
The $750?
yeah,
Yeah, because you did a service and they didn't pay you at first. Then they paid you later. Yeah, they paid you later, right, they paid you later. So that's why the receivable is, because when you did the service, you know, once you perform a service, it's automatically revenue. But if they don't give you the money, you gotta post the receipt, accounts receivable. So they, you know, they owe you money for that service you perform. Then they're gonna subsequently, they're gonna pay you. Then you gotta redo that.
So
receipt.
basically, you're in a negative that amount.
Well, it won't show as a negative because you already posted it in revenue, and that revenue is gonna go to your income statement as it revenue. So it won't show it right then, and it's gonna show the asset. Because it's a receivable, the receivable is an asset, so it's gonna boost up your asset on the balance sheet too. So it won't show it there. And you'll see later on, in chapter. Forgot what chapter, I should know the chapter. We're gonna dig deep inside of accounts receivable. Because you may not get all of that, some people may not pay you, and you'll get a chapter where we're gonna talk about that. Yes,
So if instead of R11, this instance is to be performed, so it's deferred. If it was confirmed, it would just be service revenue.
yeah. She said if it was performed, not to be performed, it would just be revenue, and it will just be revenue. Absolutely.
It's revenue, not service.
Well, service revenue, depending on what it is. If you're doing a service, it's service revenue, but if you're selling something, it's what? Sales revenue. If you're renting something, it's what? Rent revenue. Yeah. But it's good stuff, ain't it? Y'all enjoying yourself? Yeah. Y'all got any other questions out there that's in your mind? You say, hey, man, answer this question for me. Yeah, if you can do this, I think you'll be all right. You do these transactions like that, you do these steps, understand how this thing flow, it should be fine. But, that's all I have for today. That's all I have. If you have any questions that come up, y'all can find me. You can find me and email me and email your instructor or whatever. Y'all can email me if you want to. Have any questions? Yeah, we just got over this.
I've been doing it.
You've been doing a lot of them.
But, you know how there's the. First,
Mhm.
where would you do the print out, the revenue, where would it-
Well, the expenses and revenue will affect.
for the liabilities?
Well, no,
That's what I'm thinking.
yeah, expenses and revenue would affect the equity.
But
It would affect the equity.
it was, expensive and
Revenue would affect the equity. Mhm. Yes. That's how the equation is. Yeah.
what I was thinking, like, I'm trying to do something.
But your expenses and your revenue is going to move over the equity, make the equity go up or down. All right, gang, I think that's all I got. Unless y'all got any other, yeah. That's it, that's the flow. Absolutely.
I think it's still like, ask questions like which one of these is an account, or like.
Sure, I mean, they didn't answer, yeah, is this an asset, is it the liability, yeah, they're gonna answer something like that. Is this account, what type of account this is? Yeah, they're gonna ask. Sure, so you guys definitely know what type of.
But it was the burden, like,
No, let me stop this recording.